The biggest threat to your portfolio isn't a market crash, what stocks you've picked, or your allocation. It's you and your behavior. Let me tell you a quick story about a former client and an egregious mistake they made. This guy, a bit older than me, literally left the market because Obama got elected and didn't get back in until about 2018. His only saving grace in this whole thing is that he was a great businessman, ran his own companies, and made money there. But his portfolio missed out on massive growth. Because you are watching this video, you don't have to be that guy. Here are the 5 biggest mistakes new and sometimes older investors make. Mistake 1 is never getting started. The single biggest mistake in investing has nothing to do with picking the wrong stock. It's that little voice in your head whispering, I'll start when I have more money, or I'll wait until the market calms down, or I don't like the president. I get it, investing can feel a bit much with all the acronyms, charts, so-called experts shouting at you from every screen. The fear of making a mistake like losing money right out of the gate is kind of paralyzing. So what are you gonna do? Wait for the perfect time to jump in? Like, what are you doing? There is no perfect time. It's a myth. While you're waiting, the market is moving on without you. Historically, broad stock market indexes go up more often than they go down over long periods. So waiting for the perfect dip often just means watching as prices climb higher. Are there better and worse moments to add risk? Sure. I actually track that. I run through my market indicators with my Patreon members and tell them straight up whether I'm leaning bullish or bearish right now. But I want to be really clear about something. That's a tool for people who are already investing. It is not a reason to wait because waiting has a huge price. The cost of this delay is staggering, all because of one concept: compounding. It's the engine of wealth, where your returns start earning their own returns. Every year you delay is a year of compound growth you're never going to get back. The fix here is simple. Just start today with whatever you have. It doesn't matter if it's $500, 50, or even 5. The habit is infinitely more important than the amount. The goal is to get your money in the game so compounding can start working. The best way to do this is through automation. Set up an automatic transfer from your bank account to your investment account every week or every month. This approach is called dollar cost averaging. It takes the emotion and procrastination out of the picture. You're no longer deciding if you should invest, you're just executing the plan. The second mistake is letting your emotions take over. This shows up in 2 ways that seem like opposites, but are born from the same place: panic selling when the market falls and chasing hype when a stock rises. Both are about reacting to short-term changes instead of sticking to a long-term plan. Panic selling is driven by a term called loss aversion. Research shows that the pain of a loss feels about twice as strong as the pleasure of an equal gain. So when your portfolio turns red, your instinct is to sell just to make the pain stop. But selling in a downturn is the fastest way to being poor in retirement. Even worse, you'll likely be too spooked to get back in, which means you'll miss the recovery and the market's best days, which often follow the worst declines. The flip side is hype chasing returns. You see a stock, a crypto coin, or some new thing exploding on X or YouTube. Everybody seems like they're getting rich. So you pile in, usually right around the peak, just to provide some exit liquidity for early investors. You're buying high and selling low. It's the worst investment strategy besides not investing. You might as well start betting on parlays. The cure for your decisions is to have a boring plan before you invest a dime. Just write down your goal, your time horizon, and your strategy. For instance, my goal is to retire in 30 years. I'll invest X amount a month into a portfolio of low-cost index funds. I will only check my balance once a quarter and will not buy or sell based on any headlines. Mistake number 3 is putting all your eggs in one basket. This is a classic rookie mistake: betting the farm on a single investment. Maybe it's a stock in the company you work for, a tech giant you love, or a can't miss tip from a friend. This is called concentration risk. We fall for this because of something called familiarity bias. We are drawn to what we know, and we mistake that for familiarity for safety. Just because you love a company's product doesn't make its stock a safe bet. The history of the stock market is a graveyard of once dominant companies that seemed invincible. Think of Enron, where thousands of employees had their life savings in company stock only to watch it evaporate. Even if you get lucky and pick a winner, A single stock carries what's called unsystematic risk specific to that company or that industry. The great news is this type of risk can almost be entirely eliminated through diversification. By not diversifying, you're taking on a ton of extra risk. And for most investors, this doesn't improve your risk adjusted returns. Diversification is the closest thing to a free lunch you'll ever get in finance. The solution is beautiful in its simplicity. Diversify. But don't worry, you don't need to go out and buy hundreds of different stocks yourself. The easiest, most effective way to do this is to buy a low-cost broad market index fund or ETF, such as VOO, SPY, or even IVV. Mistake 4 is ignoring fees and taxes. This mistake is the sneakiest of all because it doesn't feel like a big deal. The numbers look so small. A 1% fee on your investment fund, you don't even see the advisor take it out. That sounds harmless, right? Well, that's wrong. Over your lifetime as an investor, fees can be a ravenous and wealth-destroying thing. If you've made it this far, hit that like and subscribe button, and let's just continue. A fee is a guaranteed loss. Your investments can go up or down, but you always pay the fee. And just like your returns compound, so do the costs. A 1% annual fee might not sound like much, but over 30 years, it can devour hundreds of thousands of dollars from your final nest egg compared to a low-cost alternative. In fact, study after study shows that one of the best predictors of a fund's future performance is simply its cost. Lower is better. Now, taxes are your other killer. Many new investors start with a regular taxable brokerage account and trade frequently, which can generate a heavy tax bill from short-term capital gains. The solution here has two parts. First, become a fee detective. For any fund or ETF you consider, find its expense ratio. For major US index funds, you should be aiming for an expense ratio well under 0.1%. That might be a bit higher in other countries or certain 401k plans, but the principle is the same. Hunt for the lowest fees, avoid funds with high expense ratios or sales fees. Second, use the right tools for the job. For most investors in the United States, this means that before you put $1 into your regular taxable brokerage account, you should look to max out tax-advantaged retirement accounts like a 401k, or even a Roth IRA. These accounts allow your money to grow either tax-deferred or with a Roth, completely tax-free. That tax shield is a massive booster to your long-term compounding. This final mistake is about your ego. It's the belief that you're clever enough to outwit millions of other smart people by perfectly predicting when to buy low and when to sell high. The research and a century of market history are brutally clear on this. It's a fool's errand. Even professional fund managers with armies of analysis fail to consistently beat the market. Market timing is so destructive because you have to be right twice. You have to know when the perfect time to sell is and then the perfect time to get back in. Famous studies on the S&P 500 have shown that if you missed just the 10 best days in the market over a 20-year period, your total return could be cut in half. Those best days often happen right after the absolute worst days. Exactly when you're most likely to be sitting on the sidelines in cash, waiting for things to feel safe again. Research firms like Dalbar have documented this for years. They show a huge behavior gap between the market's return and the actual return the average investor gets. While the exact numbers are estimates and change over time, the conclusion is always the same. This gap is almost entirely explained by bad timing. The fix brings us right back to where we started. Here's the cliche you have heard a bunch of times, or if it's your first time hearing this, it won't be your last. Instead of trying to time the market, focus on your time in the market. The move is to invest consistently, automate everything, and just stay invested through the good times and the bad. This is where that dollar cost averaging comes in. It forces you to buy methodically. Don't try to predict the future, just be disciplined. As you can see, the thread connecting all these mistakes is about human nature. It's about letting short-term emotion, ego, and fear get in the way of a simple, disciplined, long-term plan. The secret to successful investing is mastering your own mind. By sidestepping these 5 mistakes, starting early, automating your investing, diversifying with low-cost funds, slashing fees and taxes, and staying in the market for the long haul, you are putting yourself light years ahead of the pack. You're building a foundation for lasting wealth. If this clicked for you, do me a favor and hit subscribe for more videos on building wealth the right way. And I really want to hear from you. Drop a comment below and tell me which one of these mistakes you've been most tempted to make. We've all been there, and just admitting it is the first step to beating it for good.